Exercise price. When you join a startup, you're often given options either on joining or some period of time after joining. And there is a set value, a fair market value, also called the 409A valuation value of price per share that on the day of your joining, the stock is deemed to be worth. Now that value may also be a fraction of the value that the preferred share owners would pay, which is a good thing for you because it's cheaper for you to purchase your stock options than it is for a venture capitalist, say, to purchase their interest in the company. So you're getting a better deal than the venture capitalists or any other private investor in the shares that you're getting in the company. And that's called the exercise price. So the profit that you receive in your for participating in this startup is not just your salary and not just the intrinsic motivation of doing something important, but also the difference between the exercise price and the value that you sell your shares for. Now there's lots of complications that brings in terms of when you choose to exercise your options and tax implications that revolve around that. And I'd like to give you a worked example as to talk to what the implications are. Worked example. So say you join a company and you join the company at the time when there's 10 million shares outstanding at $1 a share. So the value of the company at that stage, maybe there's 20, 30 people in the company. It's doing a couple million in revenue or whatever. And you get options that are priced at not $1 a share, but your exercise price will be the 409A valuation, which will probably be something like 30 cents a share, because the preferred shares have at that stage more value than the common stock. So let's zoom forward 5 years, and your 30 cents a share exercise price, which reflected a value of $1 a share in the time, perhaps, in terms of the preferred shares. 5 years later, the company has done very, very well. The company is no longer worth $10 million. It's worth $130 million. And so that's $13 a share. And the company, say the company is acquired at that stage or has some liquidity event, goes public, whatever. You have the right to exercise your options on those shares. And for every share that you held at 30 cents a share, they're now worth $13 a share. And you can exercise your options at the 30 cents a share. And there's only one issue, is that all of the value that is created there at $13 a share is taxed as ordinary income, because if you then go and sell the shares immediately, but even if you don't, it's still taxed as ordinary income, because if the shares are of value to the marketplace of $13 a share and you're paying 30 cents a share, then that $12.70 is ordinary income to you at the moment that you exercise the option. So when you choose to exercise an option matters, and you want to perhaps exercise the option earlier in order to minimize your tax implications and to get more favorable tax treatment, if you can afford to do that. Or you want to time your exercising of the sales of your stock so that you're selling your stock and exercising your options at the times that are sort of de-risking the investment potential of your stock options. So if the shares are worth $13 a share year 1, year 8 or year 6 or whatever, that you're involved with a company, then by year 7 they could be worth $20 a share. If you sold everything at year year 6, then you're giving up all that value and that growth of that company. So you want to time your exercising of the options to when you're selling the shares. The best thing you can do, if at all possible, is to exercise your options before anything major happens that changes the 409A valuation of your company. So if through the years your 30 cents a share ESOP 409A valuation, if it went down to 10 cents a share through some adverse effect, but you still believed heavily in the business, go ahead, exercise all your options, pay the 10 cents a share times the number of shares out of savings or out of cash compensation or whatever you can do to buy your options at that low price. Because 3 years later, when it's worth $13 a share, you'll actually be receiving the whole $12.90 different in market value as a capital gains rather than as ordinary income, and you'll end up paying far less in taxes. These are all considerations that go into exercise price and option exercise for the ESOP programs. Exercise price. By the way, this is not legal advice, and your situation is definitely very different than the situations I've just described. So please consult somebody in the know. VC Lingo. Lingo.